This is one of those situations where the line between investing and gambling gets severely blurred. Hello, and welcome back to the Retirement Thinking channel. I'm Mike Wilson. By now, you've heard all about the activist social media group that took on the big Wall Street hedge funds. The members of a Reddit group decided to act together using the free-to-trade stock app Robinhood to buy shares of struggling companies like video game retailer GameStop and the popular movie theater chain AMC. Now, why would they do that? Well, one of their stated reasons was to punish the hedge funds who targeted these companies by holding significant short positions on them. Now, what's a short position? Well, in a nutshell, short sellers are betting that a stock's price will go down. Basically, they're holding a position as though they've already sold the shares at a certain price. For this move to be profitable, they have to close out the transaction by buying shares below the price where they are short on the stock. To do this, they actually have to borrow stock and pay rent. The rent isn't insignificant, so the longer this lasts, the more costly it gets. Of course, if the short seller's bet is wrong, they can also lose significant money if the stock price goes up, which is exactly what the activists in this case were hoping they would cause. With movies and video games going more and more to online distribution, the hedge funds made the bet that brick and mortar businesses like these would see their market share dwindle. I can see the logic here. That is, of course, unless thousands of Redditors collectively decide to buy your stock in a short period of time. In my opinion, the hedge funds acted completely unethically, not by shorting GameStop, that's fine if you want, but afterwards they did everything they could to convince anyone who would listen that GameStop was worthless, and that's wrong. Hopefully, these people will get all the attention they deserve from the federal regulators. Oh, and by the way, the folks at Robinhood were also selling their users' information to the hedge fund industry, so not exactly fighting the system. The press, however, is treating this event as the democratization of Wall Street. In the past, small investors haven't been able to affect the stock prices like this. But according to CBS News, despite this moment of crowd power, many small investors sustained huge losses as the pumped-up stocks quickly plummeted in price. This is one of those situations where the line between investing and gambling gets severely blurred. The activists were looking for stock gains, but I wouldn't really call what they did investing. Even if an actual individual investor is successful at picking winning stocks some of the time, active trading works against them in the long term, which makes stock picking more like gambling than investing. According to Dr. Shlomo Benartzi, co-head of the Behavioral Decision-Making Group at UCLA's Anderson School of Management, research has shown that this kind of strategy increases risks. He writes that although active investors are trying to minimize volatility by market timing, which is dumping losers and trying to pick winners at the right time, they end up doing exactly the opposite. According to the research, the volatility of the actual investor experience is nearly 50% higher than the corresponding volatility of stock returns. In other words, and this is really an important point, even if there were no transaction costs, you'd be significantly better off buying and holding. Disciplined investing requires staying committed to a broadly diverse portfolio that's engineered to meet both your risk profile and your time horizon. This is true even when news headlines are touting 10x gains in an individual stock. Financial news about a skyrocketing stock is usually about as meaningful as last week's lottery numbers. It's not a mystery. Big stock winners are not hard to identify in the rearview mirror. A trusted advisor can help you understand your long-term strategy and stay disciplined when the crowd is chasing short-term winners. So that's what's in my retirement thinking today. If you don't have a trusted advisor or you're hearing something on this channel that intrigues you, feel free to reach out and we can have a conversation. As always, your likes, shares, and subscription help me get the word out. If there's a topic in your retirement thinking that you'd like me to cover, feel free to let me know. Thanks for watching.